let's get into this Mortgage Bankers Association piece because I think that it talks a lot about kind of the mindset of the lending industry.
Yeah.
And from their perspective, now this is going back to the second quarter, but a lot of it's still applicable for today.
Yeah.
So
some of the stuff's a little old too. They have their interest rate projection at 3.875
for the 10-year?
No, not for the 10-year, for the Fed funds
rate.
For
the Fed funds rate, 3.75?
3.875 about at the end of 2024.
Well, that's just as, I mean, like, I love these little time capsules.
I know.
You know, because everyone, we don't know. No one knows.
Now, it would be interesting. Now, and they also have unemployment at 4.6 and 0 for 2024 and 0.3 for the GDP for that year. So they may be, forecasting.
They thought there was going to be a recession.
Yeah, that's
which a lot of people did. So like no judging there.
I still am thinking about recession, and there was at least one article this past week that talked about how the discussions of recession are starting to bubble up again, and we're talking about how bad things are for multifamily operators and investors and all, and just across the board, you name it. I'm sure other industries have their own form of stress that these high interest rates are being.
Yeah, and it's very analogous.
Yeah,
I'd say not that. Yeah, very analogous.
Yeah, and so in that way, the Fed, these are the long and lagging, and the long and variable lags are also driven by a little bit of a denial that. Well, wait, no, things are going to be okay. Things are going to be okay. And so he has to make an Instagram to remind us that we're serious.
Yeah, it's hoping on statistics, which sometimes.
But to return to the report itself, it doesn't really throw a whole bunch of curveballs that we didn't already know about the multifamily market, but it does include some numbers that clarify the current state of things when it comes to multifamily lending. It's a Q2 report again, but it does show you, even though it's like a calm before the storm kind of thing, man, it shows multifamily loan originations down 51%. You also see the breakdown of different lender types, but I just thought that, as one data point, this decrease of 51% year over year, it is telling, and I think it says a lot about multifamily sales. Specifically, you can look at it. So page 25 shows graphs on multifamily permits, starts, and completions, like we were describing. And it shows how starts have outpaced completions for the past few years in a way that I think stands out from the typical progression. And I was mapping this alongside like interest rates and recession periods. And this is not necessarily like predictive of recession. The way that these permits and starts are, it more is a product of the low interest rates at that time. And you can see at the end of this graph how the past quarter, so they only have kind of one quarter of data, how starts have just plummeted.
Yeah.
And I thought that was, it's almost invisible, but it's right there at the end.
Yeah.
And
zoom that graph in.
Yeah. So anyways, you can see how that's fallen off. And I'm wondering if Q3 is going to be even worse. But that's just kind of conjecture.
I mean, look at these negative numbers month over month. I mean, it's starting in December of 22, negative 24%, January 9, 16, negative 12, negative 5, 15, negative 16, negative 4, negative 26.
Yeah. It's really
starts the permits until a similar story, more or less.
Yeah. And I can't, and I'd like to know, I'm kind of interested to see what it typically is in the winter months. If it's anything like, previous years were do starts and permits lower, in the winter compared to the summer and spring. But another piece of information is on page 43 of this report. It talks about the different types of mortgage holders.
Yeah. And
that was helpful for me to get a picture of, all right, well, if we're measuring CMBS loans or CMBS loan maturities, how much does that reflect the
they're all about algebra?
Yeah. Well, my question was, we have a report out that
it's about 8 million. So like 4 billion multifamily loans are coming due this month. Another 4 plus or minus So if 4 billion equals 12.9% of the market, the originations.
Yeah.
This is second quarter 2023 though, not necessarily 2021.
Yeah.
It should be different.
Yeah. But so if it's the same makeup, let's push it down to 12.5, because then I could say it's 1/8.
or 10, let's even just make it 10%.
Yeah.
10%. So times 10.
Yeah.
So that's 80. So it's 40 billion a month.
Yeah.
Yeah.
So there's a lot. My question is, so life insurance companies, are they issuing the same kinds of loans with the same kinds of maturities as CMBS? So CMBS, is that primarily those shorter term bridge loans and floating rate loans fall in that?
But most I think that they can be, floating rate. A lot of the CLO is more of the bridge loan from my understanding.
Okay.
But yeah.
And my other question is
the banks and thrifts.
Yeah, that was my big question. So the banks and thrifts are the largest.
There's banks, thrifts, and others would most likely be the bridge loans and the debt funds.
Okay. And so these commercial banks, and they call them thrifts, even though I think thrift is just a bank that doesn't have loans. So I don't know why they'd put that in. And either way, I'm quibbling. 38% is banks and thrifts. A clear plurality, not a majority, but I want to know. Yeah, I'm wondering, do they do floating rates?
Who?
The banks and thrifts.
Sure.
And we don't have data on that.
Most of it's floating.
Yeah. Okay. All right.
It's really it's the agencies that are really most of the fixed rate and some of the life co stuff, but it's mostly
very interesting.
Fixed rate.
And if you scroll down, you can see how this makeup has changed throughout the years, and how specifically CMBS seems to have fallen off considerably. All right, so there's this other chart in the report where it shows the makeup of these loans at any given moment. So what was the proportion of CMBS loans to bank and thrift, and you can see how, to put it short, how the CMBS volume of loans fell after the Great Financial Crisis, while the bank and thrift portion has risen the most out of any other one.
Yeah.
I think the agency one is like a linear. It's as linear as you can get.
But you can see. I mean, agencies really started picking up.
Yeah, it has ticked up.
Especially after 2007, 2008. So much of the distress in the commercial space was all tied to CMBS products.
See, I was surprised. I thought that agency would take up a larger percentage, because that's kind of what I'm familiar with and what we kind of look for, these longer term and agencies, and as such an attractive product. But
if we're just talking about, this is not just for multifamily, this is all commercial real estate and multifamily. And so in that context, it makes more sense, because the life insurance, I'm a little surprised that life insurance is so high and above. Is that the line that I'm looking at? The highest one is that bank and thrift.
The second lowest line is life insurance, and the lowest line is CMBS.
Is bank and thrift. That makes sense. Yeah, they're just okay. Yeah, that makes a lot more sense. Bank loans, because most commercial real estate. I mean, commercial real estate prior to 2006, 2007, it was like all CMBS, and then CMBS kind of, I mean, obviously didn't go away completely, but it became very unattractive. It's one of the most cumbersome types of financing you can get. Sometimes they can just turn it off. In COVID, CMBS market just stopped. They just turned it off entirely.
Yeah.
And so that it was an immediate shift to banks came in saying, oh, okay, well, we'll lend on office buildings, we'll loan on retail. Mm-hmm. Now the agencies, Fannie Mae and Freddie Mac, and bringing in HUD as well. They were around, but they became much more attractive in multifamily, and agency financing has been the most popular financing in multifamily. But bank lending still popular. In bridge loans are included in bank financing typically, and then also the rise of debt funds and a lot of non-bank lenders.
Spencer, you were right again. Now, this is just for Q1 and Q2 of 2023, but it does show agencies as the number one lender of the multifamily market.
Yeah.
Wow.
Yeah. Oh, yeah. Yeah, because I mean, they got
that's
they got government-backed guarantee.
Yeah.
I mean, it's basically government, U.S. insured, the rates are lower. It's if you want fixed rate, it's not the only place a bank can give you a fixed rate, but typically it's not. And it's relatively commoditized, and investors who are buying the bonds, they're still securitized into these big K loans. Investors love it, especially in a pre-COVID environment or when interest rates were lower, because you can get some good yield, and it was perceived as getting a much better. You're getting a little bit of premium, for not taking a whole lot of risk, because the default rates for multifamily are so low, less than way less than 1%, and so there's which this leads to potential other systemic issues of all these institutions that have been loading up on commercial real estate debt, and that the mark to market on a lot of those bonds aren't nearly as good. If you look at it today, the value of those loans today are underwater. Same thing with U.S. Treasuries.
So the value of Fannie Mae loan that an investor can get a piece of, that is worth less now than it used to be, because of the interest rate shift.
Okay. Yields up, price down. So the yields up for a new loan. If I go out today and I'm an investor, and it's a double whammy. So if I'm an investor, I go out, I want to buy. I want to go out and buy some mortgage-backed securities.
Look, and I just had that line graph up that showed what you described, how the agency picked up the pace from CMBS as well.
If you're an investor, I want to go out there today, and the yields are 7.5%. But I took out I bought a bond in 2020 or 21 or 2019 that was yielding 3%, 4%. That's a big difference. Wow.
It's like the SVB kind of thing, or was it Signature Bank?
Exactly.
Yeah.
So if you hold a bond to maturity, you just get your yield and it's fine. You don't lose money. But if you want to sell that bond beforehand, there's a net present value of those future cash flows relative to the prevailing interest rate.
It's all good as long as no one asks for the money.
Exactly, or if you don't have to sell it. But so not only as the price has gone down because of what rates you can get today, the demand has gone down also because there's other places where you can get yield. I can go into a treasury bond and get a super solid return. I don't need the extra basis point or two. Maybe I want it, but so that demand for mortgage-backed securities has decreased, and so the values down. So just like the inherent net present value has decreased, as well as just the demand for the product. And that's one of the reasons that, Ginnie Mae investors, Ginnie Mae bonds are the government insured bonds that, like HUD loans. When you take out a HUD loan, they're packaged in, they use kind of Ginnie Mae. It's kind of like their Fannie Mae equivalent, and these Ginnie Mae bonds that these bond investors buy. Big institutions, pension funds, whatever, banks, insurance, whatever. That there hasn't been that much demand for Ginnie Mae bonds, because you're not getting the yields, you're not being as attractive. It used to be that on a HUD loan, again, backed by these Ginnie Mae bonds, you get a lower interest rate than if you went with Fannie Mae or Freddie Mac, just because it was just the way it was structured. It was perceived to be even lower risk. There's just no demand for that. So the interest rates are higher.
I wrote writing these rates for the last week. This morning's newsletter, really, and the HUD loans, I think they're more than Fannie and Freddie.
Which never used to be the case.
And
you can sign up for our newsletter, by the way. Link below in the description. GreatCapitalLLC.com/newsletter.
You can see how I am getting use out of it, even personally.
Everybody. Matt, speaking of the newsletter, and again, the link below in the description. It's so cool to see. I see people imitating the newsletter time and time again. It's cool to see. It's because ours it's still the Report's still the best newsletter. But people have caught on. I think there's a demand for this type of information. What we're doing, what you're doing.
I feel like a proud father.
Yeah, exactly. It's good stuff, and having these conversations. So, Matt, anything else on this this piece from the Mortgage Bankers Association you want to?
Not necessarily. I just wanted to show what the makeup of these lenders are, and And it can kind of give you an idea of what to expect. If you know that, okay, a lot of these loans are locked up in longer term, but there is a sizable portion that are shorter term. And I think that those shorter term are going to be vulnerable. Even if maybe it's only 40% rather than 60% of the loans that are out there. I don't think that everyone is in the multifamily lending market is insulated from the dramatic shifts. And I know I'm repeating myself, but when I'm talking about like false hope and stuff, but I think there is a whole lot of motivated communication that there is no reason at all for them to admit that there's going to be a problem until the very last moment, because like what good would it do? So
yeah,
we may not know about this until that horrible phone call starts.
The only way someone's going to find out about it is if they're subscribed to the grid.
Oh, yeah. We're the first person to find out. They're going to know when they get that phone call from the creditor that's like, this is it. and then that person, the next phone call is to us, is to the Gray Report, where we report on it. I think we get the first call. That's true, actually. We will be calling you.
Did you see the latest episode?
That's great. That's funny.
Sometimes I hear Jerome Powell speak, and I'm like, I think he watched the episode last month.
Wait, you think he's speaking directly to you?
No, I didn't just listen to it. Oh man,
I think he may be.